All right, we're recording. And I'm letting everybody in. Everybody's coming in. Give it another minute. Some more people coming in. Oh, the lovely little faces. All right.
Good morning. Morning, everybody.
Good morning.
All right, Allison, whenever you're ready.
I am ready. Good morning, everybody, and happy Friday, and welcome to the Prime Professionals Group. We have a great program for you, as always. I'm excited to get started, but before that, I always have to throw it over to Chas for a little bit of housekeeping. Chastity?
Good morning, everyone. Welcome to another wonderful virtual Prime Professional Group presentation sponsored by Allegiance Home Health. We're super excited to have you here today. Just a little bit of Zoom housekeeping. If you have any questions that you want to ask, please use the little chat box, which is at the bottom of your Zoom toolbar. At the bottom of your screen, you'll see a little bubble that says chat. You can put any questions that you have. You can direct them as everybody to see them, or if you want to direct them directly to me or Allison, you can just click on the little arrow that goes down, select their name, and you can put the question in there and you'll become anonymous. I want to let you know that this presentation is being recorded. So if anybody is a little camera shy and they do not want to be on the recording, you can just shut your camera off and you'll still be able to hear and see the presentation. If you don't mind, we'd love to see your pretty little faces. So you can say on the recording will be available on our YouTube channel for you to see again later on, or share it with your friends and colleagues who may feel that this presentation is important to them. So enjoy the presentation.
I feel like I'm at Disney, Chas. That was something that I would hear waiting right before the Disney ride. That was so perfect.
I think I've been to Disney too many times.
That sounded great. But what I would love to do now is introduce our wonderful sponsors who have been with us from the beginning. They not only have an amazing company, which is Allegiance Home Health, but they're pretty darn nice people themselves. So Rosie and Joe Martin, please.
Good morning,
Good morning.
everyone.
Thank you, Alice.
Thank you. Thank you. Thank you for being here today. We're excited to hear about our sponsors. I'm sorry, about the speakers. We own Allegiance Home Health. We started Allegiance back in 2005. We had a physical therapy clinic together. And when my mom became ill, I was not satisfied with the home health that she was receiving, and we knew that we could do a better job. And we are blessed to have Allegiance Home Health with wonderful employees. And what we do is we provide home health in people's homes. We have nursing, physical therapy, occupational therapy, speech therapy, and caregivers that go to your home. We also have a division of private duty, and those are caregivers that really are very caring. They are like companions to so many people, especially now during COVID, where there are a lot of facilities that are not allowing family members to visit. So we're getting lots and lots of calls for private duty. So our companions and our aides can be with their family member, and through technology, they're able to talk to their family member. We have over 300 employees. We're a 5-star Medicare certified home health agency. There are over 12,000 home health agencies, and less than 5% are a 5-star rating. And we've also earned Home Care Elite for the last 10 years, where we're very proud of it. We can't do any of this without our wonderful staff and clinicians.
Good morning, everybody. Once again, my name is Joe. Thank you for attending. This has been a really nice series. The Chamber has done a great job during this whole pandemic thing. I kind of like this format. I'm not gonna say I like it better, but I like it. I wish we could all get back to normal as soon as we can, but that might not be too short of a time here. We wanted everybody to know we're doing everything we can to protect the community from coronavirus, as our employees are all, any clinician that goes to the home has their temperature taken daily. They fill out a form in case there are any symptoms that they may be having, and of course they're tested on a regular basis. Clinicians that are going to the home, they're tested either weekly or bi-weekly, depending on what facility they're going to, and they're kept to a tight geographical area, so we're not mixing and matching our caregivers and clinicians, trying to reduce the spread. If anybody has any questions regarding home health, hopefully we explained it. We wanted to make this as quick as possible, but if you need any help in the home as far as healthcare goes, feel free to contact us. Thank you.
Thank you, and thanks again for your sponsorship. We really, really do appreciate it. What I'd like to do now is I'm going to go in alphabetical order according to the box that we have the participants. And if you could just quickly give us your name and company. And I'm going to go ahead and start with, let's see, it looks like Adelaide. Adelaide, are you there?
Yes, I just had to unmute myself. Thank you very much. Adelaide Cordes from Boca Raton, and I represent Mary Kay Cosmetics. I'm an independent contractor.
Thank you. Craig Schneider.
Good morning, everyone. Craig Schneider from LSIA Wealth and Institutional from down in Parkland, Florida right now because the office is closed.
Okay. I guess this is out of order. I apologize, but I'll go on the order I have. Margie Osborne.
Good morning, Margie Osborne with the beautiful Wyndham Deerfield Beach Resort. Good to see everyone.
Pat O'Meara.
Good morning, everybody. Pat O'Meara with Trustbridge, which is the combination of Hospice by the Sea and Hospice of Palm Beach and Broward County. Good morning.
Thank you. Alexa.
Hang on, I just had to unmute myself. Hi, I'm Alexa Lanier. I'm with 2 Men in a Truck. We have offices in all over Broward County and Palm Beach.
Thank you. April Stewart.
Good morning. My name is April Stewart. I am with Fort Lauderdale Behavioral Health Center down in sunny Fort Lauderdale. So thank you guys so much for having me today.
Thanks for being here. Claire Eckert.
This is Claire. I am with Pannone, Lopes, Devereaux, and O'Gara. Very pleased to be here with you today.
Well, welcome. George Rizzuto. Is George there? Okay, well, we can come back to him. Gregory?
Yeah, this is Gregory Fuchs. We're VR business brokers in Boca Raton. Glad to be here.
Great, well, welcome. Ken Tolchin.
Good morning, everybody. Ken Tolchin from Green Education Foundation. We help families and their students choose the right college for the right reasons at the right price.
Good morning. Laureen Panula.
Good morning, everybody. Laureen Panula, Competent Bookkeeping Services. Doing just what my title says, competently doing your books, one day at a time.
Thank you, Laureen.
Welcome.
Mindy Strum.
Good morning, everybody. Happy Friday. Mindy Strum, South Florida Mobile Notary. I'm a notary public.
Thank you. Cytherea Baker.
Good morning. Cytherea Baker here with the Healthcare District of Palm Beach County.
Thank you. Renee Johnson.
Hi, good morning. It's so nice to see everyone's faces, and this is a great way of providing this educational content to the chamber members and others. So I'm with Wells Fargo Private Wealth Management, and thank you so much for this opportunity to join you guys this morning.
Thank you. And George Rizzuto, are you back with us? Okay, I guess he just sent a message. He's having audio issues. but he's looking forward to today's presentation. And George is the CEO of West Boca Medical Center. So that's from George. Did I miss anybody? If I missed anybody, please just speak up, because I tried to go down this list, but it jumps a little bit. No, I didn't miss anybody. Well, welcome. We have a great presentation for you today. I know I'm looking forward to it, and I think everybody else is as well. And what I would like to do now is I would like to introduce our speakers. And first we have Leah Foertsch. She is a skilled estate and trust attorney with extensive experience representing Florida clients in all areas of trust and estate administration and planning, asset protection, wealth management, business succession planning, and tax strategies. She has managed multi-million-dollar real estate transactions, including structuring deals and providing title insurance for both commercial and residential properties, and has worked with individuals to develop successful succession planning strategies to meet their goals and objectives. In addition to her law degree, Leah earned a Master of Laws in Taxation and is a member of the Florida Bar, Tax and Real Property, Probate and Trust sections. She's a senior counsel with Pannone, Lopes, Devereaux, and O'Gara, and they are located in Boca Raton. So Leah, thank you so much for being with us. And next, our next speaker, Jason Palmisano, is a distinguished Florida Bar Board certified lawyer in wills, trusts, and estates law with over 10 years of extensive experience advising clients in a wide range of areas, including trust and estate planning and administration, wealth management, asset protection, charitable giving strategies, and in all matters of tax planning, including multinational tax, and advising clients on business and succession planning. In addition, his practice includes preparing a wide variety of trusts, including grantor, special needs, and qualified personal residence trust, among others. In addition to his law degree, Jason earned a Master of Law in Taxation and graduated from Leadership Boca class of 2018. He is a senior counsel with Pannone, Lopes, Devereaux, and O'Gara, located in Boca. Welcome to both of you, and I know we're very excited to hear your presentation, so thank you.
Thank you, Allison. I appreciate that. Yeah, so we are grateful to be able to present to you this morning, and I want to just give you a brief overview of our firm before we get started. Pannone, Lopes, Devereaux, and O'Gara is based in Rhode Island. There's about 35 attorneys up in Rhode Island. We do essentially everything up there. And Leah and I are full-time in our Boca Raton office, and we have a special focus in trust and estate practice, business planning, asset protection, estate administration, and litigation down here. We have about 3 to 4 attorneys who go and travel back and forth from Rhode Island and Florida. And so again, we're very excited to share with you today about business succession planning. And one thing that is important in business succession planning is to understand that it's really a process. And I really enjoy this statement by Lou Mazzullo that gives an overview of business succession planning. I want to highlight a couple of those points. He makes the point that it's essentially an orderly transfer of the management and ownership of a business to avoid liquidation, unnecessary taxes and other expenses to the family, and to carry out, other objectives besides tax issues. And so really what you have to understand in business succession planning is it's not a one-time event, it's a process. And so the overview of today's presentation is to give 5 steps that can help business owners or perhaps your clients think about the business succession process and what are some of the issues that come up with a business succession plan. For example, some of the issues they might consider is, should the owner sell the business during the owner's lifetime? Maybe the business owner has been doing it for several years, or maybe they've been doing it a short time and they've built up a nice business to sell, and it's a kind of a hot market in their particular area, and they want to sell now. and they don't want to keep it until they pass and pass it on to their children. Well, that's something that needs to be prepared for. So that's an issue that needs to be considered. Or in the alternative, instead of selling, should they maintain the business until they pass away for the family and pass it on to their heirs, to their surviving spouse, to other business partners, and what is that going to look like? Who will control the business after the owner's death? Is that going to be a partner, a co-manager? Again, maybe a child or a surviving spouse. That's an issue that needs to be considered and planned for during life to avoid kind of a default situation where maybe there wasn't a plan in place and something happens and maybe the business owner becomes incapacitated and they're getting home health care, and then all of a sudden maybe a power of attorney person needs to step in, or what their business documents provide for a successor manager. Those things are better handled, we think, if they're thought of beforehand and planned for beforehand. And so that's kind of what we're going to talk a little bit about over our presentation. Some additional issues would be who's going to manage the business, not only the ownership of the business, but the management of the business. So maybe, a business owner wants to keep the business within their family, but there's a key employee that's been helping and managing the business, and that key employee is going to continue to do that. That's good, but that should be specifically spelled out in certain planning documents and provided for, so that there's really no confusion, no litigation. I mean, being an attorney, litigation is very expensive. You want to avoid that really at all costs, because it can be really expensive, really stressful, and time consuming. And so pre-planning will be very, very helpful in the succession of a business plan to take care of these issues. And then the last issue there on the point is, are the children going to be treated equally in the distribution of an owner's estate? And so we'll talk a little bit about maybe there's one child that wants to maintain the business or stay in the business, and another child really doesn't want anything to do with it. That's fine. And but instead of leaving the plan to maybe a basic trust that leaves everything 50-50 to two children, and then all of a sudden one child doesn't want it, and the other child, and the business is 90% of the value of the decedent's estate, well, that's going to cause some issues, and it's best to plan for those types of things. So, the point being, in this business succession planning process, there's all these different issues, and there's lots of different of matters to consider. So, that's why we wanted to title this, Start Planning Now. And even on this call, there's a bunch of different advisors that handle different areas of this process. We're obviously attorneys, but we're just one part of this process. And so it's important to kind of get an overview and start thinking about some of these things for either you or some of your clients.
And as Jason mentioned, this really is a process. And I think one of the things that we see all too often is people decide they want to sell the business, and within months they're sort of at the point of closing without any real preparation or planning ahead of time. So really you want to look at business succession through a very long lens. And part of that is at the beginning of the process is to begin to assemble your team of advisors. And we have some suggestions on the screen now as to who might make up that team. And of course, the family's attorney, the company's attorney. I think in a lot of small businesses that might be the same person. And with that, I think that's fine in a lot of cases, but you do want to see whether that person really is qualified to handle all aspects of your transaction before necessarily proceeding. The CPA also is definitely a necessary component, as well as that qualified business appraiser. And with that, I think what rounds out your team are the banker, the trust officer, the insurance professional, and your family business consultant. And I think folks really do themselves a disservice when they decide that maybe their transaction isn't necessarily big enough to pull in some of these parties, because I do think each of them makes up a necessary component if who can put together a successful business succession plan and then help you to implement it.
Yeah, and I think especially in estate planning, business planning for our clients, it's so important to keep their advisory team in the loop, not only in the business succession plan, but in their estate plan as well. For example, a client may be engaged in gifting business interests or partnership interests to their children. So they may transfer 2 partnership interests a year to their children. Well, we've seen situations where the accountant wasn't aware of that they were doing that. And obviously that has an impact on income tax issues, on gift tax issues, or maybe vice versa. Maybe the accountant or another advisor helped them with the transfer, but the estate plan attorney didn't know that, or the corporate attorney didn't know that. So they need to maintain the corporate books. The estate plan is a little bit different now if those things are happening. So it's very important in keeping all the advisors on the same page. So in a business succession plan, it might be helpful to have one advisor who's a quarterback, and they're kind of maintaining and in charge of communications with all other different advisors. And we like to get clients release, if you will, for advisors even to talk directly with one another. For example, talking with maybe a business broker who's helping with the sale, excuse me, and an accountant and a corporate attorney along with the estate plan attorney, and the client gives us freedom to talk to them directly, then circle back with the client to give them an update. So point being, and like Leah said, sometimes you may need 2 advisors because the business doesn't need a team of 15 advisors, but maybe you do. And of course, it's different for every business depending upon the size and the situation. So
I think a real importance definitely is planning ahead and putting this in place maybe years ahead of the potential transfer.
So yeah, so in these 5 steps, the first step, we want to encourage clients to think about, okay, who do we really need to be involved in this process, and start reaching out to those people or finding some of those people to help them.
And one of our second component is determining the valuation. And of course, you want to kind of set forth a range of values, what would be acceptable in terms of what the market would support and what the seller would need. We can look at various scenarios for that, like a leveraged buyout, an IPO, the liquidation of the business, as well as your standard asset and stock sales, and as Jason mentioned, the transfer amongst family members. And valuation is necessarily a forward-looking process, and I think one of the issues that we're going to see going forward is with the current events, with partial shutdowns, full shutdowns. 2020 isn't necessarily going to be a good reflection of what a business might be worth from a cash flow standpoint or future revenues. So I think it's going to be really hard to predict and hard to value. And of course, our CPAs and business brokers on this call might have an opinion on that as well. But I foresee it being kind of posing a bit of an issue. What's a buyer going to be willing to pay when revenues kind of fallen off a cliff? With that, we have, of course, the PPP loans, which I didn't realize there's been $519 billion loaned under the PPP program. So I think there's a lot of businesses out there who have received some form. I think the average loan is about $108,000. And with that being a contingent liability, I think the issue that's also going to be an issue in valuation, in that if you've received a PPP loan and it's contingent in that it's forgivable if you meet certain conditions, that's not necessarily going to be a liability from a valuation standpoint. But on the buyer side, the buyer would have to meet those contingencies in order to enjoy the forgiveness of the loan or the loan conversion to a grant. So I think that's going to be interesting going forward, and I'm not entirely sure how it's going to be solved.
Yeah, and I think something else to mention in the valuation, of course, if you're selling a business, you have specialists that can value the business, and depending upon how you sell that business, the valuations will yield different amounts. But if you decide as part of your business succession plan to transfer your business to your heirs or to children, there's different techniques you can use, different trusts you can establish, and it's really beyond the point of this call. But the point is, in the valuing the business, say it's worth $10 million, but when you give a portion of that business to an heir in trust, for example, that portion of the business is not valued at a flat 10% of the business. For example, a $10 million business, and you want to give 10% to your children, it's not necessarily just a $1 million transfer. There's ways to minimize that value which the IRS recognizes as lack of marketability and lack of control of discounts, which can really leverage a client's ability to transfer a significant amount of wealth, if that's part of their business succession plan, to their heirs. So point being is, when you're valuing the business for different purposes, and if that purpose happens to be transfer to your heirs, there's some really neat planning techniques to really kind of constrict the value of that business so you can transfer more of it at a reduced cost. And the cost being, as some of you may know, is currently there's a very favorable transfer tax exemption. It's about $11.5 million per person. So if there's a married couple with a business, they can transfer $23 million without paying gift tax during life or estate tax at death. But my point is, they could transfer possibly a $50 million business and contract the value of that business through transferring portions of that business to their heirs. So the valuation, of course, is very important, and it may be a good time at this point to engage in the sale if your business is, if it's a business that can take advantage of these opportunities. Although I think that's maybe a little bit on the lower side, but it could be a good time to look into selling a business. Or if the business is maybe valued lower because of the recent events in our world, the rest of this year, someone might be thinking, okay, I have $11.5 million exemption. My business might be valued a little bit lower based on what's going on in the world. My goal is to transfer the business to my children. So this might be a good time to look into transferring that and take advantage of the low valuation, because I anticipate next year or a couple years from now, it's going to pick back up again, and the value is frankly going to increase significantly. So, of course, all these different things to think about, but I hope those are something that you find interesting to consider.
With what Jason said, I've always been kind of a sky is falling when it comes to the transfer tax exemptions, and I tend to prognosticate in the future that those exemptions being decreased dramatically, in which case maybe this is a good time to consider taking advantage of some of those intra-family transfers.
Yeah, so the family issues in small businesses is huge. Our country, I don't know the exact statistics, but I've seen something like 75% of jobs are from small businesses. And although when you transfer it to the second generation to the third generation, I think the third generation, and only about 12% of the businesses make it that far. Now that's partly because maybe they wanted to sell, and that's fine, and there's good reasons for not doing so. But maybe it's not, and maybe it's only fell apart because of family issues. And of course, every family has their issues, but it is really important in the small business succession planning to think about those issues, to frankly discuss those issues, and plan for those issues. And some of those topics we have listed here. For example, retaining control with existing owner or owners. When we talk about transferring a business to heirs, there's some neat ways to transfer the business from the original owner while still maintaining control of the business. They can recapitalize the business. Maybe they only had one class of shares and they were all voting shares. Well, you can recapitalize that business into voting shares and non-voting shares, and transfer the non-voting shares to maybe children in further trust, retain the voting shares. So you transfer out some of the value of the business, but still retain control. So, but those are all things that need to be discussed. Go ahead.
I think with the heirs too, that if your plan is and your intention is to vest the business within your kids, this is really the time for an open and honest discussion with the kids, and really an evaluation of your children's ability to handle that business and their ability to get along. It's a great time to have a family meeting where you do have an open and honest discussion amongst everybody as to what the roles might be. As estate attorneys, I think we've seen too many times that, there's really only three ways it can go when you transfer to your kids equally, right? Either the kids all get along and everything's fantastic. You have an even number of kids and they deadlock and the business can't move forward. You have an odd number of kids and one of the kids is left out in the cold. None of those, I mean, well, the first one's ideal where everybody gets along, but the next two, not necessarily. So planning on the front end can avoid those types of outcomes.
Yeah, and you really want to satisfy the estate planning objectives in that if your goal is to treat the children fairly, and you have one child, or equally, I should say, and one child wants to maintain and control the business and continue to manage the business, and the other child really doesn't want anything to do with it. Again, there's some neat planning objectives you can utilize with, if it's life insurance for one child and then transfer the actual business interest to the other child. Those things need to be planned for, because if they're not, then what's going to happen is if there's estate planning documents in place and it wasn't specifically provided for, it's going to be distributed according to those documents. And if the documents are generic and that they provide 50% to one child, 50% to another, then that's what's going to happen to the business. Whereas if it's you know, all the business to one child and the other child is provided for through maybe life insurance or other assets or other capital assets like commercial property or real property, what have you, those things can be planned for. And it makes it so much easier on the front end when you plan for those things. Because unfortunately, we see it all too often when on the back end, and after something's happened and maybe the business is being distributed to the successors and there's family strife, and then all of a sudden attorneys get involved, and then besides the cost and expense, you have strained family relationships, which, you know, it's not something that anyone really wants, but there's personal issues involved. And so I've seen, you know, and in fact I know consultants now, and their job is to have these annual family meetings and start talking about these things. And maybe one child doesn't want anything to do with it, that's fine. Or maybe there's some charitable purposes that the family wants to get involved in, and that child wants to sit on the board of a private foundation that's established or something like that. You know, all those things are really available to business owners that maybe have seen some success, and they want to help out charity. So again, that's something else that can be thought of and planned for, instead of something unfortunate happening and then there's kind of a default plan in place and everyone's kind of scrambling to maintain the business or get control or whatever. Of course, another big issue is to reduce taxes, right? So no one likes to pay taxes, and so reducing not only estate taxes when someone passes away, but also income taxes during the potential sale of the business, or when capital assets are sold from the business or whatever. Those things need to be discussed with an accountant, with the business corporate attorney, the estate planning attorney, and other advisors to make sure those are minimized. Again, there's some really neat planning that can be discussed, and we'll talk about a couple of examples to help reduce those taxes, and that can be really significant if it's planned for. The last point is reduce administration expenses, and that's really goes to kind of post death. If something were to happen and there's not a clear plan in place, you can avoid probate, you can avoid some of the litigation issues if there's some clear documents in place from the corporate side to the estate planning side, and it can really get expensive really quickly. So again, it's really helpful to the family. And even if the family doesn't, all family members probably aren't going to agree, but at least they'll know what the original owners intended, and that can be documented. And so if something were to go sideways in the future, then that's going to really help with administrative expenses and keeping some costs down low on that side. So, and even with accounting expenses and that sort of thing. So if everyone's on the same page generally going forward, then that's very helpful.
Yeah, it's definitely one of those times that you might pay more on the front end to kind of put these plans into place, but you'll definitely save in the long run by some planning ahead.
So family issues is big, and that definitely needs to be discussed. And maybe there's a family that doesn't want to discuss it with their children. That's that's okay, but that needs to be discussed with their advisors and planned for as well as possible in that situation too. So, you know, we understand every business owner is different. Might be a large business, small business. Family issues are all over the place. But again, it's better to talk about these beforehand and get those out in the open. So at least your client knows kind of what can be expected. The surviving spouse knows if this isn't in place, that's fine, but understand that this could happen. So, you know, we found that that's the best process. And the fourth step that we wanted to bring up is some exit strategy matters. So when I say exit strategy, again, that could be a sale, that could be transferring the business to your heirs.
A key employee.
A key employee, yeah. And so you want to share a couple of things about
absolutely.
the sales side?
So I'm going to speak right now on the sale of assets versus the sale of stock. Most of the marketplace transactions I see amongst small businesses tend to take one of these two forms. We're not necessarily talking about intra-family transactions, but more willing buyer, willing seller in the marketplace. So with an asset sale, there's some pros and some cons as to both, of course, but some of the pros that we see with the sale of assets is that the buyer is going to take the assets at the basis which they purchased them, so they'll be able to depreciate. The buyer also gets rid of any unassumed liabilities, so it's kind of cleaner from a buyer's perspective. That stuff with the basis I mentioned, and you can kind of have less of a problem with any minority owners of the business when you sell assets. The cons to a sale of assets are that you often have to transfer or get new leases, new licenses that can be administratively burdensome, not necessarily attractive. You also have to transfer or retitle each asset, which can add greatly to the administrative costs. And with respect to assignable contracts, this may require the consent of another party. So for instance, if you're going to transfer assets but not the stock, if you have a business lease, for instance, the landlord has the lease with the company. So that lease may not necessarily transfer. The landlord may not be willing to take on a new tenant without some guarantees from the original tenant. And with a stock sale, I think some of the pros to a stock sale are you have no need to retitle the assets, and you can maybe avoid some of the transfer costs and taxes associated with retitling. The cons to a stock sale are all assets and liabilities transfer at the carrying value, so you don't necessarily have that depreciation you would have with the sale of assets. And there's also the issue of unwanted liabilities. Any liabilities of the business go along with the stock. You like to think there's always going to be full disclosure, and oftentimes, you know, you've got your affidavits, you've got all kinds of mechanisms in place to ensure that there are, but there could still be liabilities that crop up that the buyer didn't know about that could lead to litigation down the road. So those unknown liabilities, I think, are a big issue. And then there's also some issues specific to a business. Years ago, I helped with the sale of essentially a pool maintenance kind of business. And as we're going down the road, it turns out that they're storing all of these chemicals for the treatment of pools in this warehouse, which could then lead to potential circular liability, which isn't something that I'm a specialist in, and I don't really have much of an idea about circular liability. But it's like you just kind of never know what's going to come up. So it's good to be kind of fully informed. Another exit strategy would be a sale to an Esop or to those key employees, and there's different ways to structure that. So even if the employee, I'm sorry, going back to what Jason said before, essentially you could transfer the management separate from the ownership. So you could continue to have your key employees by virtue of contracts or things like that while separating the ownership to somebody else. And then of course the sale to family members is that.
Yeah, so sale to family members is sale to grantor trust. One point I want to make when you know, possibly to sell to family members to maybe give the original owners and founders some income, and they don't want to use up their transfer tax exemption. One point to make about the sale to family members is the applicable federal rate is incredibly low right now. For example, the short-term rate is 0.17%. And that's going to mean that the family member will have to, you know, pay a very good interest rate to purchase any interest from the original owner. And that's for a short-term amount. The midterm rate is 0.41%. Again, that's historic lows. And long-term rate is 1.12. So those intra-family loan rates are incredibly low right now, and you know, they might even go a little bit lower. Who knows? But But that could be a really neat planning opportunity, a good time to transfer assets to a family member if the option is to sell to the family member. A sale to grantor trust is something we're going to talk in a little bit more detail in a slide on the next page or two. But the point there is that's a really neat plan opportunity to get appreciation of a business out of your estate. And so we'll talk a little bit more about that in a minute. Gifts to family members, which I mentioned a little bit previously. Again, an effective way to transfer assets to heirs. The current exemption amount is $11.5 million. Who knows where it's going to be like in the future? And the makeup of Congress and our administrations and the laws, and it's set to revert back to the exemption amount, which is about $5 million in 2026. But I think it'll change one way or the other before then. So if it goes back down to, say, the exemption amount is $3 million in 2 years, if you can utilize your exemption of $11.5 million now, then that's going to be free and clear. So if it happens to go down to $3 million in the future, the IRS is not going to say, well, wait a minute, you used $11 million in 2020. Now it's only $3 million, so you have to pay the tax on the difference of that $8 million. The IRS says they're not going to do that. So, we've discussed with some of our clients, now is a good time to take advantage of using some of that gift tax exemption, and that might involve transferring some business interest to the next generation. One thing to keep in mind, though, with it, when you transfer assets like that to a child or to another beneficiary, you get what's called a transferred basis. And so if, say, you transferred interest to a child directly, you say, I just want to give my daughter 10% of the company outright to her individually, you transfer it, and then 3 years down the road, you sell the company, her basis in that interest is going to be what the owner's basis is. And it might be a low basis that the owners built up the business over 20 years and they have a low basis in the business. And then there's a sale and they transferred it to a child. And in the meantime, my point is when they go and sell, there's going to be a pretty large capital gain that is going to have to be planned for and reduced if possible. Because you transfer it during life, and so there's a transferred basis. If there's a bequest, like in item G on the slideshow there, after the business owner passes away, then the beneficiary gets a stepped-up basis. And so if there's a family business and they've had it for many decades and the basis is low, they transfer it to a beneficiary at death, they get a stepped-up basis, and if maybe the beneficiaries sell the business, then the capital gains will be probably quite a bit lower because the basis at death will probably be pretty close to what the sales price is because it's a fair market value basis. So my point is, that can really have a significant reduction in income tax planning. Just something to keep in mind. I don't think that's going to be the driving issue to either transfer it during life or not, but it's something to keep in mind when you're dealing with basis in certain assets and the effect if you transfer it during life, it's going to be a carried over basis, or if it's going to be a death, you're going to get that step up in basis, which could be very beneficial. And then of course, in the liquidation of the business, it could be something that, if there needs to be a distribution of assets, then that just might have to be done and there's no other options to do that. Of course, you want to avoid that or plan for that if possible. And again, it's kind of good to get some advising thoughts on that sooner rather than later. So this is the slide that I was talking about, the Grantor Trust. So in the upper right-hand corner there, you see a GRAT. That stands for Grantor Retained Annuity Trust. And so what this means is the grantor in the circle on the left, that's the individual who creates the trust. And what they can do is they can create a GRAT, or a Grantor Retained Annuity Trust, and they can transfer assets into the trust. And in return, you see the arrow, they get an annuity payment back to the grantor. So For example, say you transfer $10 million worth of assets, your business interest, into a grantor retained annuity trust, and you take back annuity payments over a 5-year period of time. So in the end, you'll get $10 million back in your estate. But the benefit of a GRAT is that when you transfer assets into there, it's good to transfer low basis assets and assets that are going to appreciate over time. Because if they appreciate over time, any assets that appreciate, say, to $20 million, the excess appreciation, that excess $10 million will be excluded from their estate. And so at the end of the GRAT term, then it can be held in further trust for the benefit of their heirs or transferred outright, whatever the situation may be that the grantor wants to establish. And so I think one of the nice things about that is, again, the interest rate. This is tied to a annuity value of the 75/20 rate is what they call it. 75/20 being the Internal Revenue Code section that they get the interest rate from. Right now, that 75/20 rate for August 2020 is 0.4%. So that's good. So in that sense, transfer assets into this trust, you take back an annuity, it's based on the 75/20 rate. If those assets inside that trust appreciate more than 0.4%, all that excess appreciation will be out of the grantor's estate. And that can be really significant when you transfer large assets into a grantor trust like that. And it's a really nice planning tool. Maybe you have a larger company and it's going to go, you have an IPO coming up, and you transfer assets into a GRAT, you take back an annuity, and then there's a sale, an IPO, and the $10 million becomes $100 million. And that excess appreciation is outside of the grantor's estate. And now, of course, the grantors need to understand if that excess appreciation is outside of their estate, it's outside of their estate. So they can't go and say, oh, I want to take $20 million to go buy a property overseas or something like that. So of course, planning has to go into it. But if their objective is to get some foreseeable appreciation outside their estate, this can be a really nice planning tool. Then the other side of the GRAT is that the grantor can still pay the income tax on the income generated by the trust. And the good thing about that is that this, again, is an estate reduction planning tool. So if the grantor is trying to minimize their estate, then paying income tax is not going to be a gift to the trust, but it's going to further reduce their estate. So it could be quite significant, but often clients are looking for additional ways to reduce the estate. So maybe they pay $100,000 a year in income tax. They're okay with that if they understand that, because it's even further reducing their estate that they have subject to estate tax when they die. So that's one more way to reduce the size of their estate. And the use of the transfer tax exemption that can be minimal. So in a GRAT, because they're getting annuity payments back, they don't really have to use too much of their $11.5 million exemption to set up this this trust situation. It's kind of a freezing technique, they call it. So you transfer $10 million into the GRAT, you get back annuity payments that maybe total about $10 million. But the nice thing is that they're going to get all that appreciation outside their estate, and they utilize minimal gift tax on the transfer. So it can be, I don't get too complicated, but it's just something to think about, that there's a planning technique to use that could be helpful to a client. And this is another one, a sale to what they have, an IDGIT, an intentionally defective grantor trust.
We like our acronyms.
Yes. So these, now this is a little different in that the grantor creates an intentionally defective grantor trust. It's called intentionally defective grantor trust because it's defective, again, for income tax purposes. So the grantor continues to pay income tax in this situation. But what this could look like and be helpful is in this situation, if the grantor sells the business to the trust, so the grantor has to put in some seed money, say about 10% of the assets for the sale. So they put in $2 million into the trust, and then the trust gives back a note to the grantor, and the grantor pays income on that note. Again, the good thing about this is it's tied to the AFR, the federal rates that is due on that note, and they're at historic lows. If the term of the note is short term, it's 0.17%. It's a midterm note, 3 to 7 years, about 0.4%. Or if it's longer, it's about 1.12%. So, depending upon what the grantor's income needs are, and of course, they've had this business, they just don't want to give it away and not have any assets to live on. So that has to be discussed and planned out as far as income retained. But this could be a good situation where transfer it out, sell it to the trust, receive an income interest, and then again, that growth in that 20 million above avoids estate tax, which can be a really nice benefit to beneficiaries of the estate. And one other thing I want to circle back on before we leave this is when you transfer these business interests to trusts or to other beneficiaries, I touched on it previously, but there's really ways to minimize the value of that business. So the $20 million business, if that's the fair market value, you can distribute and break up the business so that there's non-voting interest transferred, there's minority interest voting interest transferred, and if that's done, then that can reduce the value of those interests, maybe 30–40%, and the IRS will say, okay, you're transferring a minority interest. That means that means they don't have the power to control the operations of the business. They don't. It's not a majority interest, so they can't, get rid of the management of the entity. So the IRS places a lower valuation on that. So a lack of control and a lack of controlling interest can really be a benefit in reducing the value of that interest when you transfer it out. So, business valuations can be done, and then you can typically get a reduction of 30%, 40% in the interest valuation when you transfer these, which helps you utilize a little bit less of your transfer tax exemption. So, again, it's something to think about and possibly utilize when you're transferring interest to beneficiaries. And so, the fifth step, again, we want to talk about, this is a process. So, it's important to take action. The first step that we have there is, kind of think about what do you want to accomplish with your succession plan and possible alternatives, all these tax considerations that we've talked about, but then non-tax considerations, right? About family. How's family going to be involved? What's their role going to be? What are the consequences going to be done with that?
And this is really the beginning of that process we were talking about. I mean, we're envisioning a series of meetings. This isn't like a one and done situation. We need to get input from the family members, from various advisors before proposing any type of plan or a variety of different plans for the owner to choose from.
Mm-hmm. Yeah, I mean, and I've seen consultants suggest, about 10 years before retirement, a business owner should be thinking about succession planning. So if you're thinking, okay, I want to maybe slow down and retire in about 10 years from now, then that's the time to start thinking of putting this in place. And 5 years from transferring management of the business out. So if you're thinking of maybe not fully retiring, but transferring the management of the business, you start planning about 5 years before that time period. So, another consideration is determine the cash needs of the business. Again, that's can be either post death. If there's estate tax issues that need to be addressed, then you can maybe incorporate some life insurance with that plan, so that you don't have to sell the business to pay the estate tax. I mean, that's really unfortunate. I think, and that's partly why the exemption, I think, is higher now, than it was just even 5, 6, 7 years ago when it was $2, $3 million. Part of the issues were you're seeing folks with farms and folks with businesses who had these large estate taxes due, and they had to sell the business to pay the estate tax. And so they don't, the government, I think they didn't want to see that happen as much. So they raised the exemption amount. But those are things that need to be determined and planned for beforehand so that you can know what's coming due. I will say that the IRS provides, if there is an estate tax due for a business, and you meet certain qualifications, then you can, they have a specific payment plan, for lack of a better term, in the code that gives you a pretty good interest rate. You can pay that estate tax due because of a business over a period of time that is a little bit more helpful than just an individual tax. So there are some provisions in the code that give the break to a small business owner, their family, to pay an estate tax. But it'd be nice to plan beforehand, maybe with some insurance or some other means to address that issue. So, I think putting some plans in place to talk with advisors and to get the ball rolling is very important. And it's not a 1 or 2 meeting type situation that we're talking about. It's really 1 or 2 meetings to even flesh out some of the issues that need to be discussed over the next 3, 4, 5 years.
10 years.
Things always change, right? And so, a child may express interest in taking over the family business, or maybe down the road they don't, and life takes them in a different direction. And that's life, and that's fine. But I think, unfortunately, we see it on the back end where plans were not done at all, and it's harder to get and maintain that business, and unfortunately it tends to kind of fizzle out or sell when maybe that's not what the family originally intended.
Or not at an ideal time to sell it because of life events.
Yeah, exactly. And so we have a client where we represent a beneficiary of a significant estate, and he was very involved in the business during life, and there's some good planning beforehand, and they set up kind of business advisors for each of the businesses and in his estate planning documents, and the son was part of that. And so that was helpful in the ongoing management of the businesses. Although I will say, with family issues, his family is still working out some of the management issues with step parents and other family relationships that can cause some tension. That's another issue that needs to be addressed, and it could be addressed with, I just want to mention briefly, for example, between spouses and marriage, they can have premarital agreements that deal with business issues. And if you go into a marriage with your spouse and you don't want your husband to, frankly, be involved in the business or get any of your business, if something were to happen, then it should be addressed in the premarital agreement. So if you pass away, or if you get divorced, then it helps to plan those things ahead of time so that those are not going to be sticking points that totally make the thing more expensive and things go sideways. So having said that, again, it's important to get the ball rolling, I think, is what we want to encourage people to do. Hopefully some of this wasn't too overwhelming, but it is a lot, and there's different advisors to consider, and maybe you have clients, or maybe you're a business owner yourself, and you need to discuss and think about, I need to reach out to this person to talk about maybe some of the issues that are brought up here to get my plan going and in place, and then review that plan annually or when significant life events happen. That's important to do. So with that, I hope you find that helpful. And we haven't been checking any questions, but we
Sorry.
do want to be able to open it up. Two questions, and we'll look and see if there are any questions.
Jason, I'm going to stop sharing your presentation real quick so that we can bring
Okay.
everybody on here. So if anybody actually wants to raise your hand and ask a question on screen, you can reach down to that participants menu at the bottom of your toolbar, and there is a raise your hand icon so that we can see it. Or if you're on screen and we can see you raise your hand, you can do that as well. I know there's a few people that had made some comments and good points to you, Leah and Jason, in the comment section.
Yeah, and I can't stress the original point in that you really need a team of advisors. You know, the accountant shouldn't be doing it all necessarily. The estate planning attorney shouldn't be doing it all. But you know, I see comments from private wealth advisors. There's some really good groups out there, and they have teams set up in place specifically to quarterback the business succession plan. And again, businesses vary, right? So it could be Fortune 500 companies, or it could be a small one-man shop. But regardless, it's really important that everyone's on the same page. And because if it's not, then something pops up and things go sideways, and then all of a sudden it leads to more expense, more hassle, more frustration. And you really want to plan on the smooth transition as possible if you're going to sell or if you're going to leave it to your heirs after death. So there's some really, really good advisors out there, and it's just, Leah mentioned it briefly, you might pay a little bit more up front, but it's worth it on the front end than dealing with it on the back end with litigation and other attorney's fees or administration fees that can be really significant. So it's really neat too, I think, in that we've seen clients that have been very successful, and they can do very neat things with charity during their lifetimes. There's some neat charitable trusts. I didn't talk much about it, but you know, again, you can maintain income streams during life for a term of years and benefit a charity after you pass away, or set up private foundations for clients that we've done with they have a particular desire to help certain things in different parts of the community. And so, you know, again, it's planning that can minimize taxes, right? That's great, but it's really neat when you can really, maybe you've had some success in business and you're able to give some back, and you can plan with some neat trust set up and income tax planning and estate minimization and incorporate family into all that good stuff. So, you know, it's really, really neat to be able to help people to do that.
Awesome. We actually have a question from the Martins. They have their hand raised.
Hi. Thank you. First of all, that was very insightful. We're believers that it's never too early to start preparing. My question is if you're establishing a trust currently and the laws change in the future, do you go by the laws when you established your trust, or the new laws, you know, five years from now?
Well, I'll say,
oh, go ahead.
I was just gonna say, it depends on a couple of things, what kind of trust you're setting it up. And so you can set up a Florida trust, you can set up a trust in a different state. Why would you want to do that? Because maybe a state like Wyoming has better asset protection for certain trusts than Florida. And some people set up trusts in international countries and all that stuff, but I don't want to get too far off. But when laws change, some of those tax laws that might change, if there's a tax issue that was taken advantage of during your life, and when the law was, say, a certain amount, then the IRS typically lets you keep that tax advantage when you took place and did it when the law was what it was. So point being, when I was talking earlier about the estate tax exemption amount, now it's so large. If it happens to drop in the future, the IRS says, look, if you took advantage of that when it was up to $11.5 million, we're going to let you kind of keep that.
If you make a trust now, you can capture the higher exemption, whereas in the future, if it changes.
Exactly.
Oh, cool.
It's a certain trust,
That was
right?
exactly my question. Okay.
Yeah, it depends sort of if the trust constitutes a transfer at that point in time. So like a revocable trust.
Do you have to make the transfer at that time or just the trust?
You have to transfer it.
Yeah.
Yeah, and that's what Leah, I think, was going to say.
Yeah. Sorry, I didn't mean to talk over you. This Zoom stuff is
No, that's good.
hard.
Thank you.
Yeah, so the point being, so say you create a trust, and if it's an irrevocable trust, and it's not part of your estate, and it's considered a completed gift, you transfer in $5 million to your trust, say. And then the exemption goes down to $3 million. The fact that you transferred $5 million out of your estate, the IRS is going to say, okay, fine, you did that. Even though the exemption amount is, $3 million now, we're not going to make you pay $2 million on the tax above it. But Leah said that, and that's a good point. Clients set up trusts or maybe have these plans in place, and there's these documents. But with trusts and with certain businesses, you have to fund assets, right? You have to transfer assets. You have to make the transfer. So it's something to consider, and something that's important in a plan is once you get the plan in place, and you got to follow through and follow up with your advisors to say, okay, we need to do this. Is this done? Tax returns need to be filed. Corporate documents need to be adhered to, so that if you get sued, they're not going to be able to come after you individually, but you're getting the benefit of that corporate protection. All these things need to be done, and that's why it's good to have a nice team around you to help you make sure all those things are in place and done properly, so that when an attorney comes knocking on your door, so to speak, and tries to get some of your assets, you can say, wait a minute, I've done this properly, and so it was done properly. So when laws change, it depends what the laws are, of course, but with exemption amounts, if you take advantage of it now, it should be good, and they won't claw it back, is what they call.
Okay. Thank you.
When you said to start planning 10 years in advance, it's like a real shocker. I don't think people really think that way. So that's great advice.
It's hard, right? I mean, if you're just living your life and running your business, you're not necessarily thinking on a 10-year horizon in terms of planning the succession of that. And I was thinking as we were presenting that our whole presentation could probably be summed up with plan ahead.
Yeah.
So.
And life is busy, right? And business owners are busy, and so this may not be the most enjoyable stuff to necessarily think about or talk about, so we get that.
We find it enjoyable, but.
But we get that, it's busy, it's hard sometimes, but I think getting the ball in motion is good. And then maybe once you get the ball in motion, and then you have someone maybe following up, pestering you a little bit and kind of pushing you along, I think that's helpful. Because people are busy, especially business owners, and it's like their life, and so they don't necessarily want to think about that, or maybe they don't even know, and so because they don't know, they put it off. But it's good to get the ball rolling sooner rather than later.
Yeah, I like Kenneth's group chat there. Failing to plan is planning to fail. I think that's something that you can't say enough. And Alexa, thanks for the comment on the picture. Although neither of us can take credit for that. We're tax lawyers. I think left to our own devices, we'd be in a gray room.
Does anybody else have a question, comment, something that they would like to ask? This is such a great topic. Now's your time.
We can, of course, be reached afterwards should a question arise. And I think at this point, I'd like to really thank Allegiance Home Health for sponsoring this. This was really, it's a nice way to do it. This Zoom thing is hard for me. I'm sure I spent most of the presentation looking up at my screen rather than at my camera, so my apologies.
It was a great presentation. So, and yes, thank you so much, Allegiance, Joe and Rosie. You guys are the best. We appreciate everybody being here. Please make sure to always check our website for upcoming events. There's always interesting ones coming up. And we have our breakfast next week with Mayor Singer. So that should be wonderful next Thursday. Again, Zoom. So thanks for being here. And we hope everybody has a wonderful weekend.
Thank you.
Thank you.
Bye.
Thank you so much. Nice to see everybody too, and hear from people. Stay safe and healthy. Bye-bye.
Thank you. Good presentation. Thank you.
Bye.
Bye.